Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here with Adrian Nicholson. Eric's in conferences and on vacations for a little while, so Adrian and I will be holding the fort down. How's your week been, Adrian?
My week's been good, feeling good, excited to be here. Like you mentioned, Eric's going to be out for a couple episodes, but always looking forward to another great episode with you, Roshan.
As am I. We've decided to select our own topics because I'm a little obsessed with banks. So I'm going to be talking about banks today. I apologize if there are some of you out there that are bored with the topic. I just think there's a great opportunity and so much to research and learn out there. But Adrian, you're going to start us off with your topic today.
I'd be happy to start us off. So I came across a new term. I'm sure you might be familiar with it, Roshan. It's called financial confidence. Have you heard about it before?
Actually, I have not.
That's really surprising, but that's something that was new for me. So when I saw the term, I just decided to do some research and look into it a little bit more just to see if there was any information that could just help me out with my day-to-day work. So it was really interesting. So I'll just go over the definition with people that aren't familiar with financial confidence. This is the belief and trust to navigate financial challenges effectively. And ultimately, financial confidence is important because with the right amount of confidence, it can help you make better financial decisions and secure your long-term financial well-being. So all good points. So when I read the definition and heard about that, I decided to make this my topic today because I thought it'd be really valuable for our viewers and listeners. And towards the end of my discussion with you, I'm also going to give some tips to improve your financial confidence. And I also have a survey as well that I'm going to go through as well today with our viewers and listeners that I think might be valuable. And there's some banking data too that I might pull up on the fly that may go along with some of the discussion that you brought forth today too, Roshan. So I'm really excited about this topic.
Great. So tell me, how did you find it? You said it's a new term to you as it is to me. How did you come across it? How did the research begin?
So I found this survey online that was talking about financial confidence. And that's what I'm going to go over with our viewers and listeners today. And it really surprised me when I found that there are a good amount of people out there that are lacking financial confidence right now. And this data that I'm going to share to you today really paints that picture. So that's what I'm going to go through today. It's a survey that was taken by a management company called Momentive, and it really highlights where people stand today regarding their personal finances. And this survey was conducted after the aftermath of the banking crisis as well. I'm assuming that's what started to cause some people to have some confidence issue when it came to their personal finances. So this survey was conducted not too long ago, so I thought that would be interesting to share as well. And it broke down different categories in this survey as well. It's broken down by age, education, gender, income, political affiliation, and race and ethnicity. So this really gives you a broad overview of where certain people stand when it comes to their financial confidence. But for this podcast, I'm just going to break it down into total and just give you some of the interesting points that I found in here. So I'm really excited to share this today.
Hey, jump right in, please.
So the first data set I'm going to share with you today is a question. It's saying that was posted to people in the survey was, how stressed do you feel about your personal finances? And 70% of the people across all categories, like I mentioned before, age, education, gender, income, political affiliation, race, and ethnicity, 70% of the people in this survey said that they did feel some stress around their personal finances. And that lined up with a lot of articles that I've been seeing, a lot of articles that have been published recently saying that there's really a lack when it comes to confidence in people's personal finances. So I wasn't too surprised after what I've been seeing, but 70% is still a large number. Granted, this data pool was pulled from about 4,700 people, so it's not a huge representation, but it was a good starting point that I found interesting. Does that number surprise you?
Well, I not exactly. The context is what I'd be looking for. Did it give you any data on, is 70% where it typically is historically, or is it higher or lower?
They didn't give any historical data on it, but I guess that's
Okay.
where those people stood right now. So
Yeah.
the next data piece that I want to share right after was which of the following contributes to your financial stress? And the top three were inflation, economic instability, and rising rates.
Yeah, see, based on that part of the answer, I bet it was higher than normal. So initially, when I asked you what it compares to, whether a 70% is the norm, I would have expected to be higher than normal
Mm-hmm,
because they selected the areas that were of concern are specific to the current economy. That to me makes me believe it's probably a higher number. And I think all
mm-hmm,
of those concerns are valid right now with what's going on with the economy. I think inflation's looking pretty good, just addressing each of the topics. I think inflation's looking pretty good in the sense that I think it's declining, it's heading in the right direction, showing that the rate hikes are working. The economy-wide instability, I don't know if that would encompass recession risk, but
mm-hmm,
that I think is still a risk that's out there. Interest rates rising, though I think that's still a concern. I think the lion's share of that's completed as well. So
mm-hmm.
overall, the one thing I'm taking away that's actually a little bit of a positive is I think a lot of these stressors that they're referencing are are heading in the right direction.
And that will definitely help out. And I'll just list off the other ones too, since we went over the three main ones. And just for review again, it's economic instability, rising rates, and then inflation. Those were the top three. The next one on those lists as well is lack of savings, medical and healthcare bills, aging, credit card debt, layoff or loss of income, and then the last one is student loan. So that's the list that causes people to have a lot of stress around their personal finance, which ultimately impacts how they feel about their financial confidence in the future and going forward. The
Yeah,
next thing I pulled off from the survey, oh, you can go ahead and comment again, and then I'll get
well,
into the next part of the survey.
I was just gonna say, I feel like the um, lack of savings. Actually, I don't know how often people are concerned about that, but I've been in the industry for over 20 years, and
Mm-hmm,
as a country, lack of savings has been a constant.
mm-hmm,
Yeah, excluding a few time periods where the numbers look better as a country that looks that's been a constant. Another one with credit card debt that I find interesting is just the data nationally. One showing that it's going up. People had it under control, particularly after all of the stimulus. Now it shows that it's going up, and then the rising interest rates
mm-hmm,
could make that a problem sooner than later. It's something that I've read and seen in many places, and have also we also discussed it last night at the event that I'm going to review with my topic on banking. So I wonder if that one's a greater concern right now, or if it should be.
mm-hmm. Yeah, exactly. And at the end of the day, it's going to boil down to the individual. I'll share this survey in our show notes so you can check it out yourself. Again, you can sort it by category. So I'm assuming a lot of these stressors may change versus how certain groups feel about certain areas, whether it's a big stress to them or not, or how that may change. Again, it's broken down. It may be different depending on what age you are or what your income level is or your overall background. That really does impact the numbers here. But I thought it would just be helpful just to go with totals, which does paint the picture at the end of the day.
Yeah.
So the next point I pulled out from the survey was, do you currently have emergency fund? And this pretty much was a coin flip across all groups. 53% do not have an emergency fund, where 47% do have an emergency fund. So it is really split 50-50, but this does play into the impact on how people feel about their personal finances as well, and a good starting point.
And that would be an area where I'd be very concerned,
Mm-hmm,
lacking an emergency fund, just because I remember once again going back to when I first started, we had said that there were four building blocks to your financial life, and one of the first one was cash. So you want to make
Yes.
sure you have that emergency fund because that'll keep you out of debt. And so that's an important one to avoid. What we used to talk about back then was called the debt cycle. People typically have a if they're in debt, they typically have a range. Let's just say it's between 5 and 10,000, and it goes up to 10, and they get concerned. It goes down to 5, then something comes up, an emergency, a vacation. It goes back up, and then it gets up to 10. They get concerned. They sort of bounce around in that range. So the only way you
Hmm.
can break that cycle is with having that emergency fund or having the cash on hand. So for those of you listening, if you don't have an adequate cash on hand and you're thinking about some of the other areas, I'd encourage you to build that first, and make
Hmm.
sure you have a good amount of cash available.
Yeah, and then sometimes you may find out that it's too much where this level has just stayed the same and you use it when emergency or unexpected expenses do come up. However, it never dips below the line that makes you feel uncomfortable. And then that's where you really have to consider or have a conversation to see whether this is being adjusted or this is the appropriate level going forward. So great example there, Roshan. Appreciate that. And then the last one I have on my list is how much money would you need to make you feel financially comfortable? And the top choice was $100,000. And then the second choice was $1 million. And again, this would change depending on whatever the category was. But the majority of people in this survey said they would feel comfortable, which would help with their confidence if they had around $100,000 saved, invested, whatever the situation may be on how it is. So that's all the information I pulled from my survey. What would be your final take from it as well, Roshan? Anything surprise you or interested? Like I said, I will share this in the show notes for our listeners and viewers so you can access it as well.
Um, any sub no no real surprises. I'm trying to think if there's anything that stands out at all. The 100,000 number doesn't surprise me. The savings doesn't. People feeling they need to save more.
Mm-hmm.
That's not surprising either. It does really vary by individual, but I'm not at all surprised by any of the outcomes with the survey. The one thing I did find is either you can call it comforting or concerning. Is this the list of concerns? Comforting in
Mm.
the fact that I think some of the concerns, though relevant now, are under control. Concerning because I think some things that should be concerns uh, are not as high on the list.
Awesome. Great. So the last thing I have to share are tips to improve your financial confidence. And I'd sorted this in order. If you're just starting out, would be a good place to start just to work up your degree of confidence around your personal finance. Number one I have is educate yourself. That's the number one thing sometimes we really promote on this podcast. Do your research, do your homework, surround yourself with a support group or people to help you just further your degree of education, overall your plan, whatever it maybe. That's a good foundation to start with. The second one is set clear goals. Having goals is extremely important because it's having something to work with, something you can track, and something that you can really allocate your assets as efficiently as possible to achieve what you ultimately want in life. And that's the name of the game when it comes to investing and financial planning. Third is to create a plan. Having a roadmap to get to your goals is extremely important because it's your guide. At the end of the day, it's showing whether you're on track or not, and something that you need to revisit as well just to see if you're on course to achieve that goal, or if you're not, what you need to do to make some changes to help you in the long run. The next thing I
Yeah.
have on, yeah, go ahead, Roshan.
Well, I was just going to say I can, with the topic being financial confidence. I have met with clients at extremely stressful, low confidence times in their lives, uh, layoffs, during retirement where they're concerned, when they are retired during times of market uncertainty, and that what you just referenced, having a plan to get to your goals, that tends to be the most powerful thing I've seen in giving people peace of mind, which may equal confidence. It may not. At the very least, it's giving them peace of mind and lowering to eliminating a lot of the financial stress.
Mm-hmm. Yeah, that's a great example. And then the last three things I have on my list of tips for our listeners and viewers is start saving, paying down debt, and then automate this. I think this is a really good start as well because this not only tracks your cash flow, but it works towards your goals and really helps increase your net worth as much as possible. Boosting your assets and paying down your liabilities is a good way to do it. And automate it as well because it makes it easier for you to not have to keep track of, where it's doing it on whatever basis you feel most comfortable with, and it's on a frequency that helps you out the most.
Yeah, I think those are excellent tips. What I was talking about earlier with getting rid of debt and breaking that debt cycle, uh, building that cash is so important, which you touched on with automated savings, and you said pay off the debt. Typically, when I would encounter someone that had issues around this, we would try to do both simultaneously. So let's say you had $1,000 left over a month, 500 towards building cash, 500 towards paying down debt. And it may be counterintuitive, just because you're never getting as much interest in the savings as you're going to pay on the debt, but that savings is what'll eliminate it. So I would tell people to view that as, yes, you're losing out on interest now, but you're eliminating debt, which means you're saving on future interest costs by building the cash up.
Mhm. Great point. And my last parting thought on this, on why financial confidence is important, and this would just be like my final quote, it's take control and achieve your goals. That's what financial confidence is all about, helping you put yourself in a good position to achieve what you want to do or what your goals are so you can have that long-term security in the future.
Yeah, I love that. I'm just going to repeat it, and I'm going to tell you later we should use this as as a possible title, or a meme that we put out. Take control and achieve your goals. I love that line.
Yeah, exactly. I appreciate that, Roshan. Thank you.
All right, excellent. Excellent. So I'm going to jump into my topic. I did tell you what it would be. It's about banking, and to give you a very short background, as I said earlier, I see this as a huge opportunity, and we're 3 months since the banking crisis, starting out in March, and I'm still digging deep and trying to find opportunities. It is somewhat of a slow moving process because I do think the risks are so high. Whenever we talk about risks, it always reminds me to say, please consult your advisor, do your research. This is not advice. This is purely for to help you find some things uh, for you to look into. And if you need help, Adrian and I are available, and Eric is not here, but he is also available to any of you that need help. So last night, I attended an event held by the Washington Association of Money Managers. It was a banking industry outlook. With what I'm researching and focused on, I thought it was very timely for me, timely for what's going on, and very much worth the time to go attend this event. There were four members on the panel. David Bishop of Hovde Group, he is on their research side, I believe. They do bank research. Bill Boyd at Piper Sandler, he does banking M&A. Doyle Mitchell Jr. of Industrial Bank. He's the CEO of Industrial Bank. So we've got research, M&A, and Hovde does research as well. I'm sorry, M&A as well. CEO of a community bank, and then we had Lori Hunsicker of Seaport, who also is on the research side, and they really just had a discussion. So some of this may not be. It was a free flowing conversation. I'm going to share my notes just on how the conversation went. So it may not be as organized as I would like, but this is where things started out. And I think gives you an idea of what people are thinking about. So the first thing that was discussed in here were margin compressions, and they used the term they used was a remixing of deposits. So what that means is banks were getting deposits at 0% a year ago. They were then lending the money out to borrowers. Mortgages back then were in the 3% neighborhood. So they're getting, in this example, they're getting the money at 0. They're lending it at 3. Their margin is 3%. Now they were saying the industry average was at about 4, and it's dropped to 3. So one thing to look at is how are banks addressing this now, and uh, they're getting hit a little bit on both sides. That was where Silicon Valley Bank's issue came into play. What I mean by that is they started to pay for deposits more than zero. You can get banks paying on regular, money market accounts in the threes and fours now, and CDs and fives. So now their costs are up because they pay that cost of deposit. Second, if they had long-term bonds, this is what killed Silicon Valley Bank. These government bonds, those values are down, and they weren't paying the 5% the bank has to pay in CDs. So there are banks that will be losing money, or they've got to find a way to address the margins. Now, just once again, going back to Silicon Valley Bank, the thought might be, well, why not sell those old loans and get new ones? If you sell those old loans, you take a huge loss. Um, and Adrian, feel free to jump in or stop me with any questions. Uh, Now, for those bank analysts out there, this seems like common sense. I just thought it was worth stating as well. The value of the bank is their deposit base, and lumpy deposits are a risk. What that means the value of the bank is the deposits coming in and staying, right? They want the deposits that stay, ideally, not the people that are jumping around for the better rates. And the lumpy deposits means if you've got having a lot of smaller accounts is better than having one huge account that is the majority of the business, or
Mhm.
a few huge accounts that are the majority of the business. Um, Bill Bill Boyd and Piper Sandler, he then said, as a reminder to the audience, price to book for banks are meaningless. It's price to tangible book and price to earnings you want to look at. And one of the concerns he raised was he expected that banks are going to have massive paper losses next quarter due to goodwill write-offs. So when a bank acquires another bank, whatever they pay above the bank's tangible book value goes on as goodwill. Goodwill is uh, is on their balance sheet, and it is just the fact that people essentially like this bank, or the value of their name or their brand doesn't have a real dollar value. Well, he had said over 40% of banks now are trading below book value. I think its number was 47%, if I remember correctly. And because of that, he thinks the regulators are going to have them write down their book value because of all the uh, write down their goodwill, excuse me, which will cause their book value to go down. So he thinks that could cause another drop in the banks in the summertime, because he thinks it'll happen this quarter. But it's meaningless. It's just on paper. But there's a concern of, if there's any bad news, are people going to have a run on the bank? One of the things that was so historic with Silicon Valley is how people could just use their phone to move money out of the bank very quickly. How quickly people can move money in this with the technology available right now.
Yeah, and I guess
So
the biggest thing that comes to mind right now too is maybe you might just see it more on an individual level when it comes to bank, where when Silicon Valley started, it was pretty much a shock to the whole banking industry. A lot of banks were feeling withdrawals and just feeling some of the frenzy across the board now, where I just really question if you're going to see that same degree again, where you may just see it on individual banks other than just the whole shock of it across all the boards. Because I got to imagine the withdrawal rates that we were seeing a couple months back have slowed down to a certain degree. But again, once you see more data come out or more issues, you could see it just on the individual level, where I wonder if you see it across the whole board like you did a couple months back.
yeah, a lot of the banks that has stabilized. By that I mean withdrawals of the deposits have stabilized, and they are actually bringing in deposits. So you can get that information from the bank's reports. A lot of them are putting out this information even in between their quarterly reports as well. So the information is out there, but that's why I've been moving so slow, and I keep revisiting this topic because it's top of mind. I'm spending a lot of time on it because one, I think there's an opportunity, but I think there are the opportunities there because the risk is so high. So any information you can get is valuable on this while you're going down this rabbit hole, so to speak, of banks and banking crisis and so on. Another thing that was mentioned was we keep talking about Silicon Valley Bank. They were saying that um, in it they never would have predicted that this bank would have collapsed, right? So that to me just shows the risk. You've got these industry experts. I think there was over 100 years of experience on the panel, and they didn't expect it. So while you're researching banks, yeah, even the experts aren't going to be able to predict some of these things, the potential risk out there. That by no means to me means don't do that. That doesn't mean don't do the research. To me, that means you've just got to be that much more diligent in your as you do your research. Another important point mentioned just with this particular quarter is I talked about margin compression, but the expectation from the analyst side, this was David Bishop with Hovde, was that the banks are saying the margin compression is greater than the street is expecting. So that information will come out in this next quarter's reports, which could be another risk for decline in bank stocks. So when I hear something like that, to me, that says the way I would approach that is I would look at it and not be putting in a full position. So, for example, if I wanted to put 3% in a bank, I would only put like 1.5, maybe. So I have the opportunity to add to it if there is a decline. The reason I split it that way is because if these things don't happen, I don't want to miss the opportunity of buying what appears to be a good deal right now. At the same time, if they do happen and it goes down further, I'd like to be able to add to the position later. Um, uh, I have this checklist that I've got for researching stocks in general, and I have a specific one for banks right now. And I've got something I'm going to add to that list, which is how they hedge their interest rate risk. What's the loan portfolio's average return? All of this is available in their quarterly and annual reports, and how much of the hedge is actually needed, right? So, um, the big issue with Silicon Valley Bank is they had these really long-term government loans that paid very low interest, but they were willing to take that because it was higher interest than the short-term government bonds were paying. And so you think government bonds are safe, they're going to pay interest. The problem is the bank has to stay in existence until it matures, and their depositors have to stay. So when their depositors left, they had a mismatch of terms. They had these 30-year loans, but people wanted their money back tomorrow. 30-year government bonds, excuse me, people wanted their money back tomorrow. So they had to sell and take a loss. So researching that is going to be an important part. That part was already on the list, and I was making note of the interest rates that they were getting. I just think I need to look a little bit more in into the hedging side of things.
What would you
Uh,
say I mean, there are multiple risks, but would you say the top risk you really look at to just if you have multiple banks, what's something that if you see on like a bank's quarterly report or annual report, you'll just stay away from? If it's like interest rate exposure, could it be just deposit outflows? What would you say the biggest commercial real estate on a bank's loan sheet? Like what would you say like the biggest risk out there for banks right now, or it could be a group of them, you say, where you just no longer research it anymore, move on to the next one?
well, so I'm starting out initially with trying to find banks that are trading below tangible book value and have a good return on equity. So I won't even spend time on the bank if they don't have those two things in place. So I think that helps eliminate some of the risk as it is. I'm actually looking for my banking investment checklist just to tell you what's on there with the research. So your question about what the biggest risk is or what would get me to go away, if they're not trading below tangible book or they don't have a good return on equity, I'm already gone. Now, so that
Hmm.
doesn't address your risk question, but what that does is that takes the majority of banks off the table, right? So it narrows the group right away. Next, when you talk about the biggest risk, I would say what deposits are at risk. I'm looking at what are their uninsured deposits, and you mentioned commercial real estate. That's another risk. So I'm not ranking these because I think they are all very important things to look into. I am looking at the deposits first, though, right? So I guess as I'm answering the question, I'm coming to an answer, which is if the deposits go away, the bank's gone,
Hmm.
right?
Yes.
So looking at the deposits, I would put that first. I am also looking at the commercial real estate loan portfolio. There is definitely a difference between commercial loans that are out there for office buildings versus other types of commercial loans, and then with the office buildings, owner occupied is in a different category than office buildings in general. So I think you've got to look at all of that. Um, I'm looking at how much they have of their capital and held to maturity loan, which was a Silicon Valley Bank issue, the safety of their dividend and their dividend payout ratio. Those are my bank specific items. And to that, I'm going to add the question I mentioned earlier of how they've hedged their interest rate risk. And I already, through my regular research, I'm looking at their loan portfolio average rate of return. However, I don't have a separate question for that. I'm looking at that when I analyze the business. I am analyzing that and their hedging together now after yesterday's event. Those are being added as separate questions to the list, just so I don't miss it. I am finding that through the research already. I guess the importance of it's just been highlighted. Um, any other questions?
That's all the questions I have. Thanks for answering that, but those are some good points.
Yeah, a couple other interesting points from yesterday. About a third of commercial loans are renewing in the next 12 months. And you've got to look at what you think the bank will do. So there was an example given up there of if there was a commercial loan that was maturing and it was paying 4% interest, but the going rate right now is to pay 8, right? Uh the bank's probably not gonna make the borrower go from 4 to 8. If they can't afford it, they'll probably negotiate with them because they don't want to. In this example, we're talking about an office building. The bank doesn't want to own the office building. If they raise the interest rate too high, they're going to have to, the borrower is not going to be able to pay and they're going to take over the office building, which the bank doesn't want to do. So, in addition uh, to looking at loans maturing, I think you've got to also look at management and say, well, what are they, how are they going to approach it? Because the other side of it, going back to deposits, is how expensive are their deposits? If they're paying, there are banks out there that are paying high rates, higher than other banks to get the deposits in the door. You'll see the CDs that are being advertised out there for higher rates. Well, if that bank's paying 5% and that lender was paying 4, they've got to bring that lender up above 5 to at least break even, right? So you've got to, it goes back to the deposits that we talked about earlier. What are their costs for those deposits? But then also, what are they going to do with these commercial loans as they mature? I actually asked a question about management because you're not going to be able to find out specifically to a loan what are they going to do. You've just got to try to research management and some of the things that are on my list already that they mentioned is you want management that are shareholders and you want management that are acting like shareholders, which you can find by reading not only the annual reports but their quarterly calls. So I think that it just in any investment, you could argue that the most important move is most important decision you make is what management team are you putting your money with. I think with what's going on with banks, it just highlights that even further. um Couple other points. Banks typically feel the pain when unemployment goes up. So There's been a lot of talk through this banking crisis. Is there going to be a second shoe that drops? And a lot of fingers are pointing towards commercial real estate. Well, if we do have increased unemployment and a recession, that might be the thing that causes the next shoe to drop. Couple ratios they highlighted: non-performing assets to assets, or non-performing assets plus troubled debt to assets. So you want to figure out um, how much is actually at risk of default with the bank. Um, Consumer issues, they're expecting consumer issues to be a risk. Specifically, what that means is uh, credit card debt's getting higher, interest rates are going up. Are consumers going to be unable to pay their credit cards, and are there going to be higher default rates, which are currently at really low levels? Um, when a bank buys another bank, they typically pay 1.5 times tangible book or 14 times earnings. We are currently at valuation levels where banks are trading for significantly lower than this. This might mean uh, there's a future mergers and acquisitions opportunities. If you're the buyer of a bank being acquired, it may be a good opportunity for you as an investor. So another thing that this panel uh, helped help solidify for me. As I've been saying for months and weeks, I think there's a huge opportunity here. A lot of what they were talking about is yes, there's a risk. You've got to be careful. You've got to do your research, but there really is a huge opportunity. And they kept highlighting how focusing on deposits are really the key. And uh, smaller banks, it's becoming more and more difficult for small banks to be independent. So they're going to have to merge. So it really is speaking about consolidation coming in the industry, which once again is another good thing from an investment perspective. So um, another guideline they gave is they said they would try to avoid banks where they have more than 20% in a specific industry. They think that's too much risk. Community banks and minority banks have more capital than ever. So that may be another good place to look at,
Yeah,
giving
I mean,
the
that
the
was
warning.
top of mind for me, what you mentioned. I mean, banks have to be extremely diversified. And then when you talked about small banks consolidating, one of the risks that you brought up was deposit outflows or withdrawals. I got to imagine that impacts the smaller banks the most because these large banks can withstand a lot larger withdrawals than the smaller banks can based on just the capital level as well. So that's something also that I really consider and look at as well.
Yeah, exactly. And I'll tell you, as I'm reviewing these notes, so this panel was last night. By the time I got home, it was pretty late. So I'm actually reviewing it for the first time as I'm presenting this to you. But to me, the major takeaways, there are some ratios: that 1.5 times tangible book or 14 times earnings as M&A numbers. I think that's very valuable. Looking at the hedging I mentioned earlier, I think is incredibly valuable. Looking at the ratios of non-performing assets to assets, or non-performing plus troubled debt to assets, also very valuable. The 2 points that to me stand out as uh, as the make or break decision when looking at this, putting your money towards something, is going to be A, how safe is the deposit base, and B, management. Neither of those are really new. They're both things that when I pulled up that checklist, which I've been using for weeks and maybe even months at this point, come up, it just really underscores that further. And I definitely, as I mentioned, found this to be a valuable use of my time. I don't go to very many of these things because I feel like they're a waste of my time. In most cases, this one I went to, I liked the topic, and I left thinking it was a very valuable use of my time. So I think they did a great job. Once again, this was Washington Association of Money Managers. Uh, Hats off to you. That was a wonderful event. I found it very helpful, and I believe it'll help me on my journey to finding some banks to invest in. For those of you listening, I hope you found this helpful as well. Once again, risks are high here. Please be careful. Consult a professional. we are here to help as well if you need the help. And these are not recommendations. I'm just trying to help you on your journey and on your path. So today we talked about financial confidence. Adrian, excellent topic. I really like discussing that today. We talked a little bit more about banks. Adrian, do you have any final parting thoughts for our listeners?
I don't. I really enjoyed our discussion as well, Roshan. I look forward to our next episode.
Well, my parting thought is a quote from Adrian. I will say, as Adrian said, take control and achieve your goals. This has been the Retirement Lifestyle Show. We'll be back next week with another great episode. Please like, subscribe, tell your friends and family, give us 5 stars, and thank you again for listening.